Let's examine a foundational defect in the standard approach to wealth creation. Most financial strategies rely on a linear loop. You work, you earn, you spend, and you repeat. This model is limited by the fixed number of hours an individual can physically output. In 2026, capital is no longer a static store of value waiting in a traditional account. It now functions as a dynamic fluid engineered to move through intelligent, automated systems that operate at speeds manual labor cannot match. As these systems accelerate, the gap between manual effort and structured capital architecture continues to widen, making the grind an increasingly inefficient method of accumulation. This creates a divide between the active physical laborer and the system architect. Without an autonomous system, an individual's time is spent maintaining infrastructure owned by those who have already automated. The mechanism to bypass this time constraint is the digital yield engine. This engine manages 4 specific stages. It deploys capital, harvests yield, executes reinvestment, and scales, all without manual triggers. Modern wealth is increasingly concentrated within these types of system-driven models. Passive liquidity functions as continuous capital generation through autonomous financial software. This process maintains itself through code rather than human oversight. A functional architecture allows the engine to operate with minimal human interference. This autonomous setup is built on 4 specific technical pillars. Pillar 1 is mobile integration, which converts personal devices into real-time control nodes. Pillar 2 is algorithmic intelligence, which removes emotional bias from capital allocation. Pillar 3 involves auto-reinvestment engines. These remove the delays and transaction costs associated with manual execution. Pillar 4 utilizes data feedback loops to adjust profit margins based on live market conditions. These pillars reduce the intervals between reinvestment cycles. Compounding moves from a slow annual calculation to a high-frequency continuous cycle. This flowchart represents the digital yield circulation engine. In standard setups, capital moves from deployment to yield in a straight line. When automated, yield cycles back to the start, creating a closed loop. As this loop rotates at higher frequencies, it generates scale. Scaling becomes a secondary effect of the loop's rotation, rather than a result of adding more manual labor. Once this engine is running, the need to manually inject new capital is replaced by the speed of the internal cycle. An algorithmic system relies on mathematical consistency, as shown by this uniform grid. The primary point of failure is discretionary human interference, typically triggered by emotional panic during market shifts. Many operators believe they can improve an algorithm by manually adjusting it during periods of high volatility. A core law of automated liquidity is to build the system before you trust the system. The risk architecture must be defined mathematically from the start. This requires hard-coded risk thresholds that the system cannot override. It requires inflexible rules for how capital is allocated across different assets. And it requires automated exit conditions to remove the element of human hesitation. Downside protection is built into the mechanics of the code, not the reactions of the operator. This is achieved through hard diversification and automated performance audits. It also requires the maintenance of isolated liquid capital reserves to handle fluctuations. If a market event requires a frantic manual correction, the structural rules of the system were not properly defined before deployment. This architectural approach reflects a broader transition in global finance. Participation-based models, which rely on human activity, are being phased out. They are being replaced by architecture-based ecosystems that run on software. This is driven by the increasing use of AI-managed portfolios. It is furthered by cross-platform liquidity routing and the tokenization of real-world assets. Operating outside these automated ecosystems is becoming increasingly difficult as the efficiency gap between code and manual management grows. Moving toward this model requires 3 steps. First, define your specific liquidity objectives. Second, segment your capital into structured tiers that correspond to those objectives. Third, deploy automation software that executes its logic without requiring daily manual input. Sustainable wealth is a product of structural design. Build the architecture, insulate the capital, and let the software run. The alternative is to remain in a manual loop that the market is moving past.